mathematics like there's no tomorrow.
Hello everyone, welcome after the break. Today we'll continue with lecture number 12 of the financial engineering course. Today is block number 2. In the previous lecture, in previous block, we discussed about CVA, potential future exposures and also exposures in general, and then we finished with the calculation of expected exposures. Today it will be more hands-on, so we will learn about a closed form solution. So for which asset classes, what kind of products you can think that you are able to derive closed form expected exposure. And then we go into Python coding, where we will simulate Monte Carlo paths for one risk factor. This will be a particular case for interest rate driven by White. And given that, we will simulate value of exposure for two portfolios, one consisting with one interest rate swap, and the second with two interest rate swaps. And then you'll be able to see also the netting effect. So what happens to your exposure profiles if you introduce multiple interest rate, or let's say products in your portfolio. That will be nice experiment. Later we'll move to the extension of the framework with the one decades to the multi-decades. I'll explain you how to do that, how to include also FX and also inflation. And then finally, the last point of today's lecture, we concentrate on CVA. So from theoretical perspective, we will derive the CVA formula. This means we include the probability of default of a counterparty into our pricing equation. In this way, we will find a relation between derivative priced under risk neutral measure and derivative priced under the, say, default measure where the counterparty can default. So CVA will be the adjustment, a value adjustment that we have to charge additional price to a client if you would like to compensate for additional risks associated with the default probability. I think that will be quite hands-on and very interesting block. Enjoy the lecture. Now let us discuss a number of special cases for which we can calculate expected exposure analytically. As you can imagine, it is not trivial in general. So when we have portfolio of different derivatives, it's not so trivial. However, there are a few cases where expected exposure can be done analytically. And think about the following scenario. If you have a cash flow, for example, simple payment that you exchange flows with a counterparty, or just you pay a flow amount of money to the counterparty. So it's a simple contract, which is one payment in a time. Then you can see that expected exposure brings the complexity one level higher. So from simple payment, one single payment, it becomes an option on that payment. So you see everything that we have in a xVA or in general about exposure calculation, we always bring the complexity one level higher. And this happens because we have always this maximum of exposures of values of our portfolio, and then we have maximum zero. This means even single flow that we will have, single cash payment would become an option on that cash. So this is something to keep in mind. Exposure calculation in expected exposure is always bringing the complexity of one level higher. This will be also seen in coming examples. So the first very trivial example is to consider a portfolio consisting only of a stock. So this is just, so we have function payoff HTS, and it only consists of a single stock. So of course, the value of a contract, we know we are evaluating everything under the risk neutral measure Q. Then we have a stock discounted to today. And of course, we know that stock discounted to today, this is a martingale. So the value is ST0 is because we are looking at valuation at time T0 as given here. So if you look at the definition of expected exposures, so expected exposures, this is essentially the definition. We are discounting the positive part of the value at time t. So it's not time t0. We cannot just simply say, let's plug it in here, everything will be fine. Of course, the problem is here we have a st0, so filtration here, st0. Here we have t. So those indices are very, very important. So this is, again, we are referring to lecture number 2, when I explained you a lot about martingales and also measures and also these filtrations, which was super important that time. And you see now actually all this knowledge comes back that we really have to know, have to have a good feeling where the filtration actually is important, when things are known and when things are stochastic. And this is super important here. So here we have this VT, and of course what we can do, we have to substitute this VT here. So of course the difference, of course, will be just that we have to remove 0 everywhere. That's basically value of VT. So this is, but then of course this quantity, this valuation, at time t0 is known, but however at time t, so future, it is stochastic. So actually stochastic because also the expectation is equal to st, and of course here is time. So this evaluates it's a stochastic quantity. Okay, now what we will do, we will substitute this v here, and then let's see what happens. So then we take this expectation and we plug it in here in this maximum. So everything resembles the same, except here for maximum, we take this expression for our payoff inside here. And of course, we can now simplify. So let's see what happens. So of course, this expectation, it's known. So this will be equal only to this part. So this is what we have here. So then we have MT0. So this part goes out. And we have a discounting of maximum of ST0. So you see, it's a trivial case because now we can recognize that exposure or expected exposure on a stock is equal to a call option with strike equal to 0. So this is the first simple case. You see, again, we started with a stock and then we end up with this expression. Of course, you can also even simplify it further because we know that stocks cannot become negative. So we know that this even further, this will be equal to our ST0 divided by MT0. And this is because this is equal, this whole quantity is equal to ST, assuming that stock cannot become negative. Of course, the maximum ST0, 0 is equal to ST. So this is the quantity. So this is a very trivial case, just to illustrate how to play with those filtrations and those conditional expectations. In the next cases, next examples, you will see sometimes it becomes a little bit more involved, and then you have to deal with a Tower property also of the expectations. So this is simple case. The expected exposure simply is equal to ST0. Actually, it's not expected exposure, we should say correctly. It is discounted expected exposure. Okay, let's go to the next example. Next example, of course, it relies on our knowledge from lecture 5 and 7. So before this filtration, it was lecture number 2. Now we add more materials from previous lectures. We have lecture number 5 and 7, where we discuss pricing of swaps and swaptions. So of course, the same story. So we have T0. Here is actually, this is not really correct. You see, this is actually this. Yeah? So this is without T. Actually, really see, because we don't have any more expectations. So this is not at T0 because those quantities on the right-hand side, they have only T. So we discounted to time T. So this cannot be 0. We will need to discount also from time T to time T0. So this is the value of a swap at time T. This is a swap. And of course, keep that in mind that if we talk about evaluations of swaps, we always look at the cash flows that become after, are available after time T. So this is important because if you have a swap and you have a sequence of cash flows, then of course, after the last cash flow takes place, you would expect the exposure equal to 0 because you already have paid everything to the counterparty. You exchange the flows, so exposure is equal to 0. And that was basically something to keep in mind also in your implementation. You should exclude the former cash flows because former cash flows, they're already, let's say, paid. So those, they don't contribute to your exposure because you already have received the payment. So here what we can do, we can also multiply with indicator that, let's say, our time t has to be, let's say, bigger. Our time is always, this quantity should be always positive. So t always has to be smaller than tk. If time is larger than time tk, this quantity should be equal to 0. Maybe the most correct would be if we have a tk minus 1, because then in this case, payments take place at time tk, so this is fine. So this means this will always be true only if the tk, if t is smaller than tk after time tk. If it's not true, then those quantities, those sums, so they will exclude the former cash flows. Okay, and now the second part is that we have to take this value of time of a swap. We take, of course, into expectation here, and then we end up with this quantity here. And of course, if you look into discussion in lecture number 7, once we talked about swaptions, this is exactly what we have. So this quantity is simply expected exposure is simply a discounted swaption value. So again, we return to the back to our previous lectures. Lecture number 7, swaptions. Now everything comes back. Why I'm showing you those simple examples? Because, for example, if you implement, and actually we will do that also in this lecture, exposure profile, what you are able to do, or you should do, is always to check whether your evaluation of exposures of, for example, interest rate swap, whether you can verify whether the expected exposure is equal to the price of a swaption based on the same stochastic processes for interest rates. So those, let's say, closed form solutions always constitute a good test whether your implementation works, whether everything nicely collapses to the, let's say, the standard basic case. In next example, I would like to discuss FX swap. So this is material we have covered in lecture number 10. So lecture number 10. We discussed FX products, and this, of course, FX swap is one of the famous example, and also rather simple because we have just exchanging flows. So we have exchanging foreign exchange flows at time t. So this is stochastic, this is foreign FX rate at time t against strike. So we look at the difference between the fixed amount and also the FX available in the market, and then we will multiply this difference with the notional, which is in foreign currency. In FX, of course, exchanges amount of money from foreign to domestic, so that will be in a domestic currency. If we look at expectation, so this is domestic, so of course we discount with the domestic savings account, and we have a risk-neutral domestic measure, and we have this expression for the valuation. This is already discussed in lecture number 10. Here again, the filtration is very important, so I always keep in those expectations those filtrations, otherwise it can be confusing when it is stochastic, when it is known, when it's determined. So T0 or those indices for time and also filtrations, please never forget in the context of exposure calculations and xVA. So we have this valuation. Let's calculate, of course, here what we can do. We can change measure from domestic risk neutral to the forward measure. This is our next step. What we will do here. Of course, we also have this forward definition that is also discussed in lecture number 10. So the forward rate, which is equal to the spot rate. And then we have a ratio of 2 zero coupon bonds. I'm not going to explain you exactly how this should work, how this is created. It comes from this risk new, let's say, arbitrage-free strategy for refinancing for the FX product. Lecture number 10 explains that. But what we will do, first we take this expectation, we change the measure to the T forward measure. So instead of money savings account, we have a domestic zero coupon bond as the numerator. Of course, this is gone. This is 1. This cancels out with this. Notional, we can also take it outside the expectation because it's constant. This quantity is measurable with respect to this filtration. We can also take it outside the expectation. And then we have this zero coupon bond, which is here. And we should also, okay, and this money savings account actually would also cancel with this. So first we take it outside of the expectation because it's measurable, and then we cancel with this money savings account. So at the end, we end up with a zero coupon bond times the notional in foreign currency, and then we have an expectation of under domestic T forward measure of a difference of FX rate and strike. Of course, strike is fixed, so this expectation doesn't matter. And for this part, we can use the definition of the FX forward rates. This is actually the same definition actually here. So I'm abusing slightly notation. I'll fix it in the slides, but here basically is FX will be equal to Y. So it's the same quantity as we have seen here. So what we can do, and we also know that at the maturity at the capital time t, those zero coupon bonds will be equal to 1. So we can simply substitute in this expectation, and then we see this expectation of YT. It is also equal to here. So then this simply becomes just a forward transaction. So we have a zero coupon bond forward FX rate minus strike multiplied with the notional in the foreign currency. So again, this is essentially known today. So this expectation, once we know the forward rate that we can read in the market, we can get this quote from the market, we know the value of this swap that will take place in the future. Next step, take this value in the domestic currency and calculate expected exposure also in domestic currency. This is what we'll do here. So we substitute this VD from the previous slide. This is what we have here. So we end up, you see, this kind of already becomes rather complicated, to some extent complicated, because now we have a mix of measures. So here we have this forward measure, then this is the solution. So we substitute this to the expression for the expected exposures. We plug it in here, and then we have the zero coupon bond. Of course, this zero coupon bond is not measurable with respect to this filtration, because this will be, it is stochastic because at time t. We have this part, we have this part. So of course, now what we can do, we can use definition of a zero coupon bond. This is what we have here. So definition of zero coupon bond is basically the ratio of the money savings account, because this quantity here, it will be equal on exactly to expectation of QD, and then we have this E minus integral from T to T, here RS ds, and we have a filtration time T. So we can substitute into this expectation, and then what happens, so this will be end up here, and then what we will see is that we end up with a kind of nested expectation. So we have an outer expectation with filtration FT0, and we have inner expectation with filtration FT. Of course, this filtration is bigger. This FT is much bigger than this one because it's later. So of course, in the future, if we look from the future perspective, we know everything up till today, and also from today until time t. So this FT is bigger than FT0. And then what we can use, again, lecture number 2, power property of expectations. So this means we can actually remove this expectation. Then we have this equivalence between the two terms. So this expectation is essentially gamma. So if we do that, many terms will cancel out because this will cancel with this will cancel with, this term will not cancel, we stays, and we end up with this of course can go outside. So we end up with the ratio of money savings account times the option value. So okay, after the cancellation, then indeed only these two terms will cancel. Money savings account, we still have it on time t and MT0. So this is fine. And of course, now next step would be to define the new measure, the domestic. So here we had a risk neutral measure. Now we have the T forward measure. So we change measure again from domestic risk neutral measure to the T forward measure in domestic market. And this is the quantity we have. And of course, we know also this one, this part, it is as discussed also in lecture number 10. This is a martingale under the T forward measure, domestic T forward measure. So this also means that we can go as we have done in the case of interest rates, especially in terms of pricing of couplets. We can define a stochastic differential equation for it, which is a martingale, and we can price using kind of Black-Scholes formula. And this is what happens here. So of course, we assume log normal distribution because fx cannot become negative. So fx is always a ratio of foreign exchange is a ratio between exchange between different currencies. So we never have a negativity. Assuming log normal process, we end up with expected exposure under the domestic measure is simply European option price with strike here is 0, and this is the solution for this option price. And of course, to price it, we use the knowledge from lecture 5, where we talk about interest rate couplets also, and foreign exchange from lecture number 10. So you see, it is again, further we go in this course, we are actually reaching the end of this course. More and more materials discussed in the previous lectures will need to be reused in order to arrive at the expected expectations and also ultimately at the xVA and also VAR or expected shortfalls. Now is the time for a numerical experiment. In this experiment, we'll consider 1D case. This means 1D or dimensionality of xVA it's typically not associated with number of trades we have in our portfolio, but number of risk factors. So 1D case essentially means we have one risk factor. In this case, we are talking about interest rate swap. So obviously, the best choice, actually, the model that we are most familiar with, and we are well covered in this course, is the whole-white model. So definition of a swap, I think everyone is familiar. So this means that we have a cash flows, we are paying fixed rate, we are receiving float rate, we have a summation of all the future cash flows, and then we can express this swap valuation in terms of those in the zero coupon bonds. Of course, sometimes it's more convenient to have this representation because then we can simply monitor which cash flows take place at what time, what period in time. Because, for example, the most important element, like I already mentioned before, is that in the evaluation of xVA, we always look at the future cash flows because those are the cash flows which are exposed to the default of a counterparty. If some payments have been already done, it doesn't matter from the counterparty credit risk perspective because you already have this money on your account. So unless somebody steals it from you, it is not really exposed to any type of risk, default risk. So this means that it's good to, if you have the summation of future cash flows, essentially we always look at the case, like I said before, this indicator function that t is always smaller than tk, and this ensures that the summation essentially will be always excluding the terms where t is already past the payment moment, which is actually here in tk period. So this is important. Also, this add-ons is kind of important. Normally you don't see it in the definition of a swap, but in terms of evaluating swap portfolio in the future, then you have to really take care of all the future cash flows. So here we will talk about not only a single swap in the Python experiment that I will present in a few minutes. We have portfolio of swaps. So we have actually two swaps, both depending on whole-white model as the main risk factor. Okay, so this is something that I mentioned before. We have a past realizations, and then from today, there are future realizations. So of course, depending on the period of time, then we have an uncertainty of a risk factor. It can be here. Further we go in time, typically there's more uncertainty, and so on. So of course, we would expect this would have impact on the exposure profiles. Question to you, do you think that always exposures will increase in time because of the uncertainty which is increasing? And the answer for this question is no, because we have two types of impacts once we talk about exposure calculations, especially in terms of swaps. Because if we have, let's say, different derivatives, that could be much more involved. But in swaps, we have a sequence of cash flows. This means that initially we have, let's say, 100 cash flows ahead of us. As long as we will be paying or exchanging the flows with the counterparty, the number of outstanding flows will be decreasing. So, of course, the risk associated with those future flows will be decreasing too. So that effect of, let's say, paying out, let's say, the same as for mortgages, this reduces the uncertainty, that reduces the risk. On the other hand, we have the impact of increasing volatility. So in case of swaps, we see this, there are two fighting effects. The first one is basically the volatility, which is increasing the part of your uncertainty. So the exposure is increasing because of the volatility that is increasing. Also, volatility is the uncertainties in time increase. And then the second part, which is the offsetting part, where cash flows are exchanging. So the cash flows, as we go in time, they'll reduce. So we pay off the outstanding payments. So we have less and less risks associated with a counterparty that would default. So again, this is the definition of a swap. Important part, indeed, always exclude the past flows from evaluations. So what is important actually, and actually why often people choose whole-white is because of this feature which is here and is extremely important. So this means that, first of all, our swap that we have, we can express in terms of sequence of zero coupon bonds. To evaluate each of those zero coupon bonds, we have to calculate this expectation. So obviously this means that our expectation will depend on path from time t to capital time t. This means essentially we have to integrate. So if you have those Monte Carlo paths, we are interested in zero coupon bonds from here to here. we have to integrate this path over this period of time. And then we have to do it for all of the paths. So it's also this path, for example, and this path in the middle. And so all those integrals will need to be taken into account, and then we take the expectation. As you can imagine, this is a very expensive part. Integration for each individual path, it is super expensive, computationally. So that's basically, you can say that's the bottleneck. However, because the full white model belongs to the affine class of processes, we can represent it as this exponent here. So we have a time-dependent functions A and B, those are given here, and then we have RT. And this is extremely powerful, because this means that we can determine the zero coupon bond price. We don't need to actually integrate paths, but we can actually evaluate based on the value of RT at this point. This is R time T. If we know this value of a path at this point, and we know those functions, time-dependent functions, we actually know the value of zero coupon bonds. And this is extremely powerful, because at this point, we don't need, first of all, simulations of paths beyond this point T. And second of all, we don't need to do any numerical integrations. We just evaluate functions. Of course, somebody can say we have to do still this integration, but look, this integral doesn't depend on any stochasticity. It's just time-dependent function. So this means that we can do it once, essentially, because it doesn't depend on the realization of RT. So this means you do it only once, and then you can sample as many paths or as many realizations for RT you want to use for your evaluation of zero coupon bonds without integrating paths. So it's extremely powerful. This is also big motivation why full white model or also affine models, maybe other in the class of affine models, are often used for xVA simulations of exposures, and also later I will show you used also for VAR calculations. So bottom line, we have to first simulate with a money savings account with a short rate, we simulate a short rate process RT, and then we have to put everything together to evaluate those expected exposures. In the numerical experiment, I will also simulate potential future exposures at different significance levels to actually see how those significant levels of confidence interval affects your potential future exposure levels. Here are some numerical results. Before we go to the Python code, I would like to discuss already some of them. So this is a profile for interest rate swap. So you see, essentially, initially, we start with a swap which has par value of 0, because this is the most common way of buying swap, like already we discussed before. The par value is 0, so the fixed rate is chosen such that the value at the inception is equal to 0. So of course, from the time t0, of course, you have if a counterparty immediately defaults, then you have no risk to just buy another swap at the par value. So this means there is no exposure for that part. However, if you go in time, you see there is this moment. So we have a 10-year swap, and so we exchange flows over 10 years. Of course, beyond time, 10 years, there is no more flows that are outstanding. So we have just 0. We see this interesting graph. It's always increasing, and then it's going down. Of course, increasing part comes from the fact that volatility for interest rate is kind of increasing. Initially, it's very narrow, as close from today. There's this moment with volatility. It's the leader of the exposure profile, and then we have this moment where it's going towards 0. And this is the moment where actually the impact of paying back the flows. So that as we go in time, there are less and less outstanding notional or outstanding payments. This actually at this point, you see that actually the impact of the flows that were paid is becoming significant, and at the end it actually goes nicely to 0. So this is important. So first we have increase because of the volatility increases. Then we have decrease because the amount of payments, they are so significant that take control of the profile of the expected exposures. Actually, exposures, and then we will see this will be expected exposure will look just like this. And actually, here is the profile. So this is actually for slightly different configuration. This is now we have a swap of 20 years. So these are the exposures. You see that those are actually not even capped at 0. So those are just the value of swaps in time. So this is the value of a swap in time. then we also have to exclude those values at 0. If we take maximum S T 0, so then there will be only the upper part. Those are the positive exposures, and then we take expectation, we get something like this. The zigzag part, so those flows that go up and down, it comes from the fact that the exposure goes down after the payment of the next payment from a swap. Exchange of the float for fixed takes place, then immediately there's an impact on the decrease of the remaining exposures. After the payment takes place, the exposure has to go down, and this is very clear that firstly it goes up because even the payments take place here. So this, you see that initially this decrease is limited, almost nothing, and then becomes significant. Because the amount of that is paid back, or let's say the cancels out, is already paid out, it takes control, and at this point you can really see everything is decaying towards 0. And this is another graph that I'm showing you. Negative expected exposure, so negative expected exposures is defined as follows. This will be important once we talk about the bilateral value adjustment. So bilateral credit value adjustment. Then we also talk about the part that we haven't discussed in this part. We discussed in the netting that we also, if we are losing money, or for example, we are obliged to pay to the counterparty, then actually we always have to pay this amount to the counterparty, and this will be expressed by negative exposures. So these are the positive and negative exposures. And here is important, so we have expected exposures. We have a potential future exposures of levels. This is 5%, so 95% confidence interval. And here we have 19. So you can imagine distribution to be something like, maybe not even like this, because this expectation should be here. So we have a very, like this distribution, and then we have tails like that. So this will be, this point, we have 5%. Here is only 1%. So 1% here, it will be 5% here, and the remaining is 95. And this is the expectation. You can think, I'm looking at this point now, T4. So this will be some more expectation of this distribution. So this is how you can think. This is the profile at given time 4. This is the profile of our exposures that we have. This is positive exposures. So let's take a look at the Python code. Let's see what kind of settings we can play with, what is the impact of different netting sets, and how we can choose those such that we can see the impact on the expected exposures, also exposures, and potential future exposures. So in the experiment, we start, of course, with a specification regarding the Monte Carlo simulation, like number of Monte Carlo paths, number of Monte Carlo steps, some parameters for whole wide model. Obviously, those parameters will need to be calibrated using market codes, typically for swaptions. So this is not discussed in this course. Calibration of a whole wide model, or in general calibration, we will discuss in the follow-up course. So this is some realistic set of parameters. We have a notion of swaps. We have 2 levels for potential future exposures. So we have this 1% quantile, and here we are 99% quantile and 95% quantile. Here I also specify a yield curve, so you see it's very simplistic one. Actually, this would be like this. So it's a 1% flat curve, initial interest rate, and of course, as already mentioned before, first part of simulation is always about looking at the zero coupon bond from the market, comparing against zero coupon bond from the model, just to see as the sanity check whether there is a no bug in the simulation of Monte Carlo paths. Okay, then the second part, we start with a specification regarding swap. So we have some strike of 1%. Swap will start in 1 year. It's up to 10 years with yearly exchanges of flows. We generate Monte Carlo paths. Here I'm generating until time 11 years. Actually, in this case, if you have a swap, you could only simulate only to time 10 years. That should be enough. But of course, this doesn't really matter because after the 10th year, there are no cash flows anymore, so this will not play any role here. Then what happens next? So we also calculate the money savings account, and now we go into the part where we calculate the exposures, expected exposures, potential future exposures, and those two, it's a PFE and PFE2, they correspond to different significance levels of confidence levels. First, we calculate the value of a swap. So we have a payer with notional and strike specified above. And this is just a configuration of the swap. So this is value of a swap we have already done before in this course. Given the full wide paths, we can just calculate swaps, and this goes naturally via the definition of zero coupon bonds that are expressed in terms of short rates. What we do is that we discount first those flows. This will be discounting taking place. This will be from, let me see. So we discount to today. I just realized we have a small mistake here because the discounting here should not take place because this value of a swap is already expressed at time ti. So this means this is a value at time ti. We don't need to discount it to today. It is just a value at time ti. Then this is exactly what it should be. So then we have a expected, then we take the exposure, the positive exposure, which is the maximum. Then we calculate expected exposure. So then we have a expected exposure, obviously discounted expected exposure. So now we discount to today, and then we look at the quantile. So you see, it's important that we don't take. So this is something to also keep in mind. There should be no discounting. This value is just a storing value, no discounting needed here. Let me double check it will be the same here, same in the portfolio. So and then so this is the single swap, and now we perform also the portfolio with netting. So here what we do, we define two different swaps, swap 1 and swap 2. That one is receiver, one is payer. One is with a strike given in above, and the second strike I just chose to be with a 0. The big difference here, of course, is one is payer and one is receiver. Now what we do, we define a portfolio at every time ti with a portfolio, so sum of those two. So then we can benefit from the nettings of the two. We store the value of the portfolio. We calculate here the exposures, positive exposures of that portfolio at given time ti. And now here we calculate discounted expected exposures from the portfolio. And at the end, we also do the quantile. Here, actually, I'm just doing the quantile for the regular without this 1% quantile. And at the end, we will show some results, numerical results coming from. So you see, it is another, if we understand exactly what is behind the methodology in terms of filtration, how to put all those blocks we have learned so far into one framework, it looks like the simulation of xVA of exposures. It looks very much straightforward. Let's take a look now at the numerical results. So of course now we have to run all these Monte Carlo paths. Let's start from the beginning. The first graph, of course, is this. This is the classical graph where I'm showing the comparison of Monte Carlo for zero coupon bonds versus analytical expression. Here we see a value of swap. So we see this is not a maximum zero, this is just a value, potential value of swaps, depending on different market scenarios. So you see it's very symmetric. It's a symmetric profile. Of course, we start at 0. After 10 years, we also have 0. And then the value of a swap can be 1,500. And also we may expect loss to be minus 2,000. So you see this is very much symmetric. But value of a swap in time, although today starts at 0, it can vary depending on scenarios of interest rates. Of course, we don't know what the future will bring. This is why it's so much important. The hedging process, where we can offset those paths with, let's say, the inverse or the paths with a different sign, so that the exposures could be reduced. Of course, practically, you would like to be reduced on this side. You would like to keep the profits. Of course, that's the rule number 1. This is part where we talk about positive exposures. So essentially, we only look at the upper side is just the same. You see this part here is also shown here. And then what we do, we look at the discounted expected exposures. So these are positive exposures from that swap. So we do flows every year. So we pay every year, and then it's up to 10-year swap. So this graph is actually illustrates what we have seen also in the slides. Here we have also illustration of, so the first one is expected exposures. You can see actually it's the same, 200 here is 200 here. And then we have the two levels of potential future exposure. So the blue line will be with 5%, 95%. The other one will be with a tail. This is more, let's say, more in the tail quantile of the exposure profile at time 4 and 6 and so on. So you can see this kind of, if you have more of those quantities, they would actually describe well the distribution of exposures that we have simulated. And now let's take a look at the portfolio. So the netting impact, the red line again is this is the expected exposures. Here we have a huge potential future exposure, so it's 5 times larger. But if we look now at the comparisons of expected exposures, you see that expected exposure portfolio is much smaller, or not much, but is smaller than the one that we got from a single swap. So the netting actually indeed works. And here, if we look at this potential future exposures, the bottom line is also coming from a portfolio, and then single portfolio, portfolio consisting of one swap is here. So indeed, in this experiment, you could really see that by adding swaps into your portfolio, you can reduce your exposures, and also you can reduce your potential future exposures. So that has impact also from the risk management. So by selling, or let's say reducing your position, you can actually buy derivatives that would offset your exposures. In that way, you would reduce those measures. And of course, at the end, this will translate into charge of CVA, or the counterparty value adjustment, that we will charge our client, depending on the probability of default, of course, but depending also on the exposure. So the credit value adjustment, counterparty value adjustment, will be impacted whether we have large or small exposures with that counterparty, or for particular trades. Of course, if we move towards multi-decays, therefore, instead of one single full white model, we are simulating multi-dimensional case, where, for example, we have a swap or portfolio of swaps, but also swaps in different currencies, then of course that requires that our Monte Carlo simulation, or our generator for scenarios, would also involve processes from different economies, different interest rates in different markets. And of course, this is also what we have discussed in lecture number 9, where I have stressed the necessity of using hybrid models for those kind of purposes. So for example, here, if we have a scenario where we have two currencies, so we have a base currency, which could be, for example, euro or dollar, and we have a DC number of other currencies. So of course, this means that we need to have also a number of DCs, a number of interest rates in foreign markets, but also we need to have the same number of exchange rates from those different markets into our base market. So for example, at the end, we don't want to have exposure in all the different currencies. Like for example, here we have a DC currencies from 1 until DC. All those trades that are in our portfolio, if for example we are assessing the exposure per counterparty, then all those trades from different currencies, they need to be brought into one currency that we can actually see the exposure profile. Then therefore we need to have a kind of, multi-dimensional system of stochastic differential equations. So here we have a 2 times DC, so one number of DCs for foreign exchange, one DC for so from 1 until DC for interest rates, plus 1 for interest rates in the base currency. And those exchanges will bring each of those kth currency to the base currency. This is important. So we see the system of stochastic differential equation can be quite large, especially if portfolio would involve multiple assets in multiple currencies. However, from the computational perspective, if we think of Monte Carlo simulation or high-dimensional Monte Carlo simulation and portfolio evaluation, still Monte Carlo simulation part is considered to be one of the cheapest elements in the whole engine of xVA evaluations. Imagine, even if you have, let's say, 20-dimensional Monte Carlo, the Monte Carlo simulation in general increases linear in dimension. So you can always add extra factor, and that would increase linearly in time. Of course, if you optimize your code properly, if you don't make any bugs, everything could be just growing linearly. However, so you can actually estimate how much time is needed. Of course, you can also apply tricks, like, for example, multi-core, GPU, etc. However, the part which is much more difficult to handle is the evaluation of the portfolio on all those scenarios. So imagine we have those exposure profiles. So, for example, those are risk factor profiles. So let's say one currency. So let's call it X. And we need to evaluate portfolio at every exposure date, at every point here. See? So already at this point, we need to have 4 evaluations of the portfolio. And imagine we have to do it for many time steps. So you have a number of time steps multiplied by number of paths. This is the total number of portfolio evaluations. Even if your portfolio consists of linear products, so therefore linear in risk factors available in the market, typically this could be thousands of different trades. So imagine how big is this computation. And typically that's the biggest limitation, or let's say the biggest challenge in the xVA evaluation is the evaluation of xVA. Actually, the evaluation of portfolio in xVA. Especially if, for example, you would like to also calculate risks. This means you would like to calculate sensitivity of your exposures to particular risk factor or market change of an instrument. This computation becomes then huge. The computational cost is very, very big, and it's really difficult to reduce that. Of course, you could think of reducing the complexity of individual trades, but of course, sooner or later you will realize that there is nothing more to be reduced because the number of trades that you have in your portfolio is actually the limiting factor. There are, however, techniques how to improve that evaluation. For example, how to reduce number of portfolio evaluations in order to get still profile which will resemble the one that I have just explained. But this is, let's say, outside of the scope of this lecture. This lecture is mainly focused on evaluations, the whole idea of xVA, what are the measures what kind of techniques we can apply to compute those expectations. Expectations or discounted expectations of the exposures for counterparty of portfolio. So you see here the dimensionality, it will be very important factor. And of course, we can also benefit from if you choose your model smartly. So if you don't go to, let's say, to exotic model for xVA, like labor market model, you actually will be able to evaluate those exposures with large time steps. Of course, you cannot make 2 big steps in xVA. Those steps need to be rather small. And later in this lecture, I'll explain why we cannot make one large step to the end. We also have to have the evaluations of expected exposures also in between our beginning of the trade until the maturity of the trade. There is important that we have multiple of those, we have many steps in between. Of course, not too many, but it's important to have some number that will, let's say, help in convergence of the certain integral. This integral I will discuss later. But of course, if we choose your models smartly, then you can actually do also large time step simulation in your simulation of a Monte Carlo path. And then if you have a portfolio consisting of multiple assets in different markets, so for example, here we have a swap portfolio, swaps in currency K, then we have to multiply with a FX that will bring us from K to the base. And of course, we have to go over all the currencies we have. So you see, this part is rather, so for every portfolio we have to evaluate 4 risk factors, and the risk factor RK, so this will be a path which comes from this interest rate K. Then we have to evaluate this portfolio for each of those paths. Then we have to sum over all those MKs. So basically this means we have to sum all those values of the trades in a portfolio. So this will be MK is the number of trades in the portfolio. And then we have to multiply with foreign exchange to bring it back to the base. And then we have to sum up over all these portfolios in different currencies, of all the sets of trades in different currencies. And of course, we have to still do it for the base scenario. So this will be a representation of how would you evaluate the exposure if you have multiple currencies. What is the portfolio composition where you have those kind of transitions between the foreign values of a trade and to the base, which will be euro or dollar, whatever you will choose. Now, let us adjust the risk-free pricing with additional possibility of a default of a counterpart. So then let us now derive the credit value adjustment CVA. We often call it unilateral. This means that there is only one counterparty, or we cannot default, but only the counterparty that deals with us can default, and that is taken into account only to evaluate this adjustment that we have to do for the risk-free measure pricing. Yeah? So we're pricing derivative under the risk-free measure, so riskless, and then we include this additional charge that is associated with the credit value adjustment. So okay, so we assume that we have transactions, first of all, are seen from the point of us. So we are like a safe investor. And then we have our counterparty is the one that is a possibility of a default. Later in this lecture, we'll discuss about the case where also possibility that we as the institution can default, and that would have kind of interesting impact on this adjustment that we have to incorporate in the pricing of derivative. Just to give perspective how this CVA adjustment works, imagine you have two counterparties that basically they would like to buy a swap from you. Of course, now in a risk-free world, you would say the value of a swap is just discounted future cash flows. But of course, if you start taking the probability of defaults of the counterparties and also possibly the current portfolio that they have with us, that could have impact on the valuation. So you see that the valuation of a swap may depend on the counterparty and also on the position that they are currently in a trading book associated with that counterparty. So kind of interesting, let's say that derivative pricing becomes indeed kind of exotic derivatives because those extra features need to be taken into the account when pricing of derivatives. Some notation, so this is important. So we denote by VD, this will be a discounted payoff between time t and capital time t. So you can say that we're observing at time t with the final payment associated with capital time t, subject to the counterparty risk. So D means this part will include the risk of default, so this will be risky price. And then by VTT, we have the analogous interpretation, but we talk about this value as the risk-free. So this means we price it like we used to do it in the whole course. And of course, the whole idea now is the objective is to link this VTT with a VDTT. So how to link the default, how to link the derivative price that may default and the price that may not default. So the connection between the two is the so-called CVA, actually in this unilateral case. Okay, so before we go into the derivations, we have to start with a configuration. We have to start about what are the possibilities if we have a transaction with a counterparty, what are the options regarding to default. So imagine we have this a swap with a counterparty, when counterparty can default, and what amount of money we can actually receive back. So we have to go through all the scenarios, put them together, and then from there we will see what is the adjustments we have to incorporate in our risk-free valuation. So the first case, of course, this is the simplest case, is that imagine we have a time of default happens after the last payment of the contract. So tau, so this is a stochastic quantity, indicates, so this is a variable, stochastic random variable that indicates time to default. So indicates when the default will place. So time of default. So you see that tau is basically now talking about random variables. Normally, if you talk about stochastic processes, we always talk about variables in this direction. So if time is here, we have some stochastic processes. Then we always talk about this direction. Of course, now if we talk about default, we are talking about default in this direction. Where is the biggest probability of a default of a counterparty? So keep that in mind. So tau indicates a stochastic random variable, or random variable indicating the default of a counterparty. So of course, if the default would happen, here we say we have a value of a derivative at time t. Now we multiply with indicator saying that if a default will happen after the next payment, what we will get? Obviously, we will get full amount because if we receive the last cash flow from the counterparty, so if the capital time t is here and a default happened here, then of course we don't carry any risk because after the contract expired or matured, the counterparty default, so that would have no impact on our position on the risk adjustment for the contract because there's no more contract. All the payments have been already done. Okay, so if we receive or we pay all the payments until the default time, so this is the scenario. So we have this now, so we have, let's say, time here with the last moment of the payment. So our, let's say, maturity of the contract. We have a time t here. So let's say a t0 today. We have a t here. Now we are discussing where, so before we had tau here, that was the easy case. Now what are the scenarios if the tau is in between? So what happens? So we receive the payments until the default time. So of course, if the default happens at this point, right, so if we have tau here, then we receive all the payments. So indeed, so we receive all the payments, tau smaller than t, and then we have payments. This will be payments until downtime. So basically, we cover all these expenses, all the transactions up to this point are handled if the default happens at this time, right? Now, depending on the counterparty, we may be able to recover some of the future payments. So okay, this is handled, but still we have outstanding part, which is here. So of course, we can also include maybe we can recover some of the money that we're supposed to receive in the future. So this means we have some here a recovery rate. So if the tau will happen at this period, so before maturity time t, then we may recover the amount of money. So if we are here, we have this outstanding amount. So this will be v tau t, and then we recover some fraction of it. So this is the case where, again, it's the same case as here. So we have to basically put them together and we multiply with the recovery rate. So this is the money that essentially tau, some certain period time tau, we may have future obligations regarding the cash flows with the counterparty. We may still recover some rate R from this outstanding the part of the contract. So okay, so we handled the case where tau was after the maturity, that was easy. Now we have handled the case when the tau is between tau and capital time t. Of course, if the tau would happen before, then we will not even enter this contract. So this is 0. And of course, now is the case, okay, what if we actually, counterparty could benefit from us? So let's take a look here. So this is the third point. If we owe money to the counterparty that has defaulted, we cannot keep the money, but we need to pay it completely back. So you see, there is no R, no recovery. If our counterparty defaulted and we have some debt to be paid to the counterparty, by law, we are obliged to do that. And if everyone would do that, then indeed, for some counterparties, that there will be some recovery of the money that they expect to receive from the counterparty. So this is basically these payments that we will do, somebody will, to some extent, recover from the default of a company. And of course, if we have this default will take place, then we expect that will be this negative part of the exposure. So if we have this exposure profile, maybe you remember, so everything what is negative, we have to pay back. So it's the full amount. Exposure is something that we can lose, and partially we can recover, but everything which is below, we have to pay back, and this is this indicator function times minimum. So minimum, we have everything on this side of those exposures at any period tau to capital time t. Of course, now what we have to do, we have to price this risky derivative, because now we have a risk-free derivative. So this was the one with no default. And now we incorporated those time of default of a counterparty. We have to put everything together, and then we have to calculate what is the expectation of the discounted future payoffs. So of course, now our filtration is time t. So this quantity, of course, is measurable with respect to the time, of course, but tau is not, because tau, it will happen after time t, after capital time t. So if we put all those cases together, so we have 1, 2, 3, 4 cases. So it's a 1, 2, 3, 4. Then what we have to do, the first step is to link maximum and minimum. And then we can use this identity here. So x equals to maximum of x0 plus minimum of x0. And basically those two equal to x. So we can then substitute for minimum x minus maximum. and then we can actually put them together. Actually, you can see here, then we end up with a recovery -1, because this will be -1. Those terms will be exactly the same. So then we end up with this part, and these three terms, and we end up with the one with the maximum. Now, another step, the second step, would be to take use the linearity of expectation and divide this expectation into two pieces. The one expectation of this part, and second expectation of this part. So the first expectation is as follows. So we have those indicator functions depending on different maturities. And here, in particular, we will leave this one alone. We have these two. So the first one tells us that we have, if we have time, we have an exposure, the value of a contract until time tau. And the second part, here, we have a value from tau until maturity time t, so this part, which is discounted until time t. So basically, and then this happens in both cases when tau is a bit smaller or equal to capital time t. So this basically means those two terms, they can be glued together. So we can put them together, and this is actually what we have. So then you see what has changed. We have a t to tau, tau to capital time t. Now we have a t to capital time t. So you see, we put this together, and then we have a from t to capital time t with this indicator function, because actually this is the same here, the same here. So then we have two cases. One is basically tau bigger than capital time t, and one when the tau is smaller than t. And of course, we also see that the value of a contract is measurable with respect to filtration. So the value we can take outside of expectation, and then we end up indicator function. But of course, this means that the whole space is covered. So this indicator function is equal to 1. So then the first three terms that if we put under the expectation term is equal just to the risk-free value of that derivative. So this is very, very nice. So these three terms that we had here is equal only to exactly equal to Vt capital time t. Of course, the second part is how to include. So this view we can actually now put in the expectation, and this will be the price of a risky derivative. So your expectation of Q under Q, VTT. And now we have this part with a convex part with a maximum and recovery rate. Okay, linearity of expectation. This is also measurable. We take it outside of expectation. Now what we have a discounting from a moment when the default will take place, until it is smaller than capital time t. We have a recovery rate. So this is the deterministic part. We have this maximum of the tau t. Of course, this part is constant. We can take it outside of expectation, and we end up with the following expression. And this, by definition, the right-hand side here, hold this term. So 1 minus recovery times this expectation, where we have a discounting. We have a default probability of a counterparty, and we have this maximum. That it's called CVA, credit value adjustment. I often call it a counterparty value adjustment or credit value adjustment. So this expression, this expectation, this is called CVA. So you see, by construction of the payoff, taking the payoff and adding possibilities when the counterparty may default, that will essentially, after those quite simple and nice steps, we will arrive at the correction that will link, you see, risky derivative with a risk-free derivative and adjustment. And of course, again, it nicely happens that this derivative, so the risk-free derivative minus the adjustment will equal to the risky one. So this means that this is always, if we have risk-free, that will be always, the risky derivative is always cheaper than risk-free derivative. So this risk premium, or let's say the CVA adjustment, the default adjustment, essentially makes this equation to work. So we always see this adjustment would correspond to the credit value adjustment associated with default probability of a counterparty. So this is the summary. So the bottom line here is risky derivative equals to risk-free derivative minus, and this is basically the key element and the exclamation mark here of this block. This is the relation that we expected to have when we started this block, and now we arrived with exactly the formulation of this correction term, let's call it. And this is also not trivial. So here we see, for example, first of all, we don't know when the default probability will take place, tau, because it can happen and from t until capital time t. So this means we would have to calculate this exposure for every time from today until the maturity of the contract, and then we have to adjust whether default took place or not, and then we have to discount everything with a money savings account. And then we have this recovery part. And one more comment regarding this recovery: 1 minus r, so this recovery rate, is often called loss given default. So what is the loss given default? And that's basically this representation, which is also in this formula for CVA, for the credit value adjustment.